Tesla's net profit fell 46% in 2025 to $3.8 billion. Nearly $2 billion of that came from regulatory credits, payments from rival automakers who could not meet emission standards on their own. Strip those out, and what remains is the margin of a volume automaker selling fewer cars each year. The stock trades at approximately 300 times that number. The market cap is $1.5 trillion. That contradiction is not a valuation debate. It is a structural problem. The business that exists is shrinking. The business that justifies the number has not arrived yet. In 2025, Tesla delivered 1.63 million vehicles globally. That was the steepest annual delivery decline in the company's history and the second consecutive year of falling sales. The EPS for the year came in at $1, a 47% drop. Operating income in the first quarter of 2025 collapsed 66% year-on-year. The operating margin that quarter reached 2.1%. That is not a technology company margin. That is barely above the floor. The standard explanation is that none of this matters because Tesla is transitioning. The car business is a bridge. The real value is robotaxis, humanoid robots, full self-driving software, artificial intelligence. Investors are not pricing today's earnings. They are pricing the future. That argument requires the future to arrive on a specific schedule. It has not yet. If you want to understand what is actually happening underneath the headline, subscribe now. The pattern is bigger than one company's quarterly results. The European data makes the transition story harder to hold. In 2025, Tesla's European registrations fell 27.8% to 235,000 units, a third consecutive year of decline. Germany, once Tesla's largest European market, fell 48%. The broader European EV market grew 34% over the same period. The industry expanded. Tesla contracted inside an expanding market. That is not a macro problem. That is a competitive position problem. The competitor is BYD. In 2025, BYD delivered 2.26 million electric vehicles, 630,000 more than Tesla. BYD overseas sales exceeded 1 million units in 2025, up 150% year-over-year. In Europe, BYD registrations rose 240% in the first 11 months of the year, the exact window Tesla was falling. BYD's automotive gross margin runs at approximately 22%, Tesla's runs at approximately 13%. The company gaining the volume has the better unit economics. That gap is not temporary. It is structural, built on vertical integration and domestic supply chain advantages that do not normalize quickly. Tesla's response to this competitive pressure is the Cybercab, a steering wheel-free autonomous vehicle designed for robotaxi deployment. Volume production targeting 2026. The pitch is that Tesla bypasses the declining car business entirely by building a network of autonomous taxis that generate recurring revenue at scale, displacing Uber and Lyft in the process. The Cybercab cannot currently be legally sold for unrestricted public road use in the United States. Cars without steering wheels require jurisdiction-by-jurisdiction regulatory clearance. That process has historically been slow and unpredictable. Tesla's robotaxi service launched in Austin in June 2025, initially with safety monitors. Fully unsupervised operations followed in limited test markets. Volume production of a vehicle for which no nationwide legal deployment framework exists has no confirmed timeline for reaching the scale the valuation assumes. Bank of America reportedly values the potential robotaxi business at up to $750 billion, roughly half of Tesla's entire market cap. That valuation is contingent on regulatory approvals not yet granted, technology milestones not yet demonstrated at scale, and consumer adoption in a ride-hailing market currently occupied by two well-funded incumbents. Analysts who value Tesla solely on its car business estimate the stock justifies $50 to $80 per share. It trades near $392. The gap between those two numbers is being held open by belief. Belief in a timeline. Belief in regulatory outcomes. Belief that four unproven businesses, robotaxis, Optimus robots, FSD software subscriptions, AI infrastructure, will all materialize on the schedule already priced into the stock. Subscribe. The people who understand where this is heading before it moves are not the ones reacting to it afterward. Tesla's CFO confirmed on the Q4 2025 earnings call that CapEx for 2026 exceeds $20 billion, covering 6 new factories. The company that earned $3.8 billion in net profit last year, with nearly $2 billion of that from competitor payments, is committing capital at a rate that dwarfs its earnings. Barclays estimated the Terafab chip facility, which Tesla plans to co-develop with SpaceX, could cost in the mid-single-digit trillions if fully executed. Musk described it as essential for avoiding dependence on chip suppliers. The facility does not yet exist at scale. Capital is also moving in other directions. Tesla disclosed it committed $2 billion to XI, Elon Musk's separate artificial intelligence company, in 2025. Tesla also sold $430 million in Megapack energy storage systems to XAI during the same period. The CEO controls both entities. Capital flowed from Tesla shareholders to XAI as an investment. Revenue flowed from XAI back to Tesla's energy division. Each transaction is disclosed. The pattern, money circulating between companies controlled by the same person, is visible in the filings. Investors are not required to be comfortable with it. None of this stays inside the balance sheet of one company. Tesla represents 2.6% of the S&P 500 by market capitalization. The Magnificent Seven, Tesla, Nvidia, Apple, Microsoft, Alphabet, Amazon, Meta, collectively represent 34 to 40% of the entire index. As of early 2026, 42% of the S&P 500's total return in 2025 came from those 7 companies. Every broad market passive fund, every default 401(k) allocation, every retirement account tracking the S&P 500 holds Tesla at elevated weight. The investor did not select Tesla individually. The index structure delivered it to them automatically. In 2022, when the S&P 500 fell 20.4%, the Magnificent Seven fell approximately 41.3%. The amplification runs in both directions. A reversion in megacap tech does not stay inside megacap tech. It reaches every account that owns the index, which is most accounts, which is most people who have saved anything in the last decade through an employer retirement plan. The workers building Tesla's gigafactories in Texas and Nevada are employed by a construction expansion funded by a company whose core product is losing global market share and whose capital commitments for 2026 exceed its entire annual profit by a factor of 5. On March 27, 2000, Cisco Systems became the most valuable company in the world. It made the networking equipment that the internet required. The equipment was real and essential. The demand was treated as permanent. Cisco lost over 75% of its market value when the cycle turned. It took 25 years, until December 2025, for the stock to recover that level. The parallel to Tesla is not decorative. Cisco was profitable and growing when the peak hit. Tesla's core business is shrinking, and its profit depends materially on payments from competitors. The structural position is weaker, not stronger, than Cisco's was at the moment the market decided it was the most important company in the world. The valuation at $1.5 trillion price is a winner. The competitive data shows a company losing its original market to a rival with better margins. The regulatory environment shows a flagship future product without a nationwide legal framework for deployment. The capital allocation shows money moving between CEO-controlled entities at scale. The index concentration shows that a correction in this one stock reaches inside retirement accounts that were never designed to be a bet on autonomous vehicle regulation. None of this means the technology fails. Tesla's full self-driving system has accumulated over 8.4 billion miles of real-world training data. That is a genuine and substantial asset. The energy storage business grew 44% year-on-year in Q3 2025 and is becoming a real revenue contributor. The data advantage in autonomous driving is not easily replicated by a competitor starting from zero. These are genuine competitive positions. The technology may be real. The 300x earnings multiple is not a technology bet. It is a timing bet. It prices the arrival of the robo-taxi network, the humanoid robot, the autonomous software subscription, and the chip infrastructure on a schedule that regulators, consumers, and competitors all cooperate with simultaneously. If any one of those timelines slips by 2 or 3 years, regulatory delay in one major state slower than projected cybercab adoption, a competitor reaching functional autonomy with a different approach, the earnings trajectory that justifies $1.5 trillion does not materialize when the valuation expects it. Cisco's networking gear kept running after 2001. The fiber was real. The internet worked. What the market destroyed was not the infrastructure. It was the assumption that the infrastructure would generate permanent, compounding, unchallenged demand at the exact pace the 2000 stock price required. The cars are losing ground to a competitor with structurally better margins. The autonomous vehicle that is supposed to replace the car business cannot be legally deployed nationwide. The capital to build the future is being committed at 5 times the rate of earnings. The retirement account that holds this stock did not ask for it. The cars are losing ground. The The robots have not arrived. And $1.5 trillion sits in between, waiting for a future that may be real, just not on the schedule the valuation requires.